Good afternoon, everyone from Geneva. Thank you for joining us today for the SheTrades Invest webinar in collaboration with Heva Fund. The topic of the webinar today is contract negotiations and managing your investment. My name is Kriti Sharma, and I'm going to be your moderator for today. And I'm very pleased to welcome our presenter, Ms. Vakuru Niguna from Heva Fund. To everyone else, I request you to please keep your mics on mute. Uh, Akiru, I believe there's some disturbance on your end.
Yeah, I think everything is okay now, yeah?
Okay. So yes, I'm very pleased to welcome our presenter, Ms. Vakuru, from Heva Fund. Heva Fund is an East African fund that invests in the creative industry sector in East Africa by offering debt, equity, and business support to enterprises and businesses. Ms. Vakuru works with them as an investment manager and is involved in the development of innovation financial models that combine elements of venture capital and impact investment. She's also a very keen advocate of gender lens investment. In the webinar today, she will talk about the key things to consider before signing equity, loan, and grant contracts, and also on how to manage your investment. Now, before we begin, I just quickly highlight some housekeeping rules. I request you to please keep your mics on mute at all times so that we can continue without any disruptions. A lot of you are still not connected to audio. I have posted the instructions in the chat box, but please go to the top left corner of your screen, click on audio, and select audio connection. And if you have any questions, please use the chat box on the bottom right corner of your screen. You can address them to everyone or to ITC Women in Trade, and we usually take all questions towards the end. Now, this is it from my end. Thank you for joining us again, and we hope that this webinar is useful to you and it adds more value. I'd like to give the mic to our presenter now. Vakuru, I'm unmuting you.
Okay. I don't know why I can't move the presentation.
Can you use the control on the left screen? You can navigate using that.
Yeah, it's hung. I think it's hung because it's not moving.
Yeah.
That's what I'm trying to do. Yeah.
Okay, let me try from my end as well. If you just click on the control, actually, you'll see the number 01, right? And you'll see these signs above and below that.
Yeah, I can see it on the left. I just can't move it. That's the issue I'm having. Yeah. So maybe, are you able to do it for me as
let me, because I've given you the presenter rights. To everyone else, just please give us 2 minutes.
Sorry. Yeah.
Okay. I don't know why this is. Okay, just 1 sec. Yeah. Okay. I am.
Okay. So,
could you try again?
Yeah, still nothing.
Okay, I will. Perfect. So I can actually move it as you speak. You just have to tell me.
Okay, sure. Okay. Hi everyone. My name is Wakiro Njuguna, and I won't because already an introduction has been done. I'll just go straight into the presentation, and it's basically follow-up of the series of webinars that my colleague Kendi and I have done for the last, I think, 2 months. So we've been talking about just want to take you through what to look out for before you sign a contract, as well as how to manage your investment.
Sorry, Vakiro, I think we lost your audio for a minute there. If you could just quickly repeat that. the brief.
Ca-
I think I can hear
Can
you
you?
now. Yes,
Okay,
now
you
I
can
can
hear
hear you.
me?
Yeah.
Okay, yeah, so I was saying it's just to finalize on the webinars that we've been having, which is on various types of investments, how to pitch the shameless self pitch, as well as how to convince or how to get investors to invest in your business. So now I just want to take you through what to look out for when you're negotiating your contract or before you sign a contract, and how to manage the investment once you get it into your business. Yeah, we can move on to the next slide. Yeah. So the first thing that we'll cover is equity contracts. Like we said, there are different types of investments. We touched on equity, loan, and grants. So the first thing will be equity contracts, and then I'll take you through loan contracts, what to look out for. I'll take you through grant contracts as well, what to look out for there, as well as managing your investment. Yeah. Next. Just go to the next one. Yeah, so with regards to equity contracts, as we all know, an equity investment is when you sell part of your company or some shares of your company. One of the things that you need to look out in those contracts is the structure of the investment. So the difference to you between this and a debt security investor is that the equity investor will only get paid once you make a profit. The debt investor, whether it's a bank or another microfinance institution, will be paid on a monthly basis. And in this case, there is no doesn't matter whether you're making profit or not, you have to pay them back as per the agreed schedule. So the one thing to make sure that you have already considered and you are already clear on is the structure of the investment. So you know whether it's equity, whether it's debt, or whether it's a grant. If it's an equity contract, you have to consider the types of shares that you're giving out to your company. So there's two types of shares. There's preferred shares and then there's common shares. Um, if your investor gets common shares, it means that you're both at the same level, meaning that you're both equal in the eyes of the structures of a company. So when when a time comes where you have to make decisions, you probably get like equal votes in the company. Um, and then also when it comes to profit sharing and loss sharing, you have a proportional arrangement if it's a common share arrangement. So make sure that if any investor comes into your company and they say, okay, we are going to buy shares into this company, you have to ask them, are they common shares or preferred shares? So that then you can have that conversation. By contrast, if your investor is getting preferred shares, this is where you really need to be careful. It means that you're disproportionate, meaning that they have more power than you. Let me give you an example. If, for example, your company has liquidity issues and you declare bankruptcy with a preferred share investor, what happens is you have to pay them first. Once you liquidate your property as a company, the money goes to this other shareholder first, the preferred shareholder. And then after you have completely paid them back, then now you start thinking about recouping money for yourself and the other common shareholders. Um, Again, the investor is probably exercising some level of control and will take a larger share of revenue than you might otherwise think if you were just comparing the number of shares each party owned. So even though both of you own maybe 100 shares in the company, they're still going to take a larger percentage of the revenue. So you have to be very careful when you're looking at such contracts, just to have some clarity around what types of shares they are and what the revenue, profit share, and the loss share is looking like in the contract. Yeah. Next, please. The other thing that you need to consider is the anti-dilution protection. So what happens when when an investor comes into your company is they will ask for an anti-dilution clause. This clause, almost every outside investor is going to request for this clause to be included because it's a form of security for them. For the small business owner, the goal is to understand how to negotiate the clause. What the clause does is once you sell, you give out your shares, maybe they've taken 10% of your company, and that is maybe equal to 100 shares. If another company comes in or if another individual comes in and they want to buy shares into your company, they will dilute this previous investors' shares. So what happens is that the very initial shareholder wants to make sure that their shares, meaning the value of their share, is not diluted, which means that they are not losing any money. So just make sure that you look out for this anti-dilution clause. And then you can know how to negotiate around it. It's always good to have people around you who are aware of negotiations and what to look out for, because then they will advise in such situations. There is also the liquidity preference, and this is a fancy way of describing what order and how the various owners of a business get paid in the event of a sale of a bankruptcy. Remember previously, there's someone here. There's some noise from somewhere, I'm not sure. Okay. Remember we talked about the common shares and the preferential shares. So in its simplest form, what happens in a company without any outside investors, if you own 30% of the business when you sold, then you get 30% of the proceeds. So like if you own 30% of your company, once you sell your company, you will get 30% of what your company is valued at that point. If there's a liquidation preference, it means that, for instance, an outside investor might say, once if you're having bankruptcy issues and you sell your company, they will want a double dip. For a double dip, it means that whatever the value of their investment is, they want double the amount. So once you liquidate, you will have to pay them double of what the value of their initial investment was. So you need to look out for these things because then that affects what you're going to recoup from the sale of this company, and if you're even going to get anything at all. Because if the clause says a double dip or a triple dip meaning that it's times 3 of what they invested, then that means that you're really in a bad place if you have any bankruptcy issues. Yeah. Next, please. There's also something else called a covenant or covenants. And covenants are basically a promise that you make to investors, and they usually include this in the contracts. Outside investors want covenants in the agreement as part of their investment because they entrust you to take their investment and run the business properly. They can include anything from a high-level requirement that you prepare and distribute monthly, quarterly financial forecasts. It could be that they want you to maintain certain levels of insurance protection. It could be that they want you to consult them at any point you make a major decision about where your company is growing, whether it's expansion, whether you're looking to bring in new products. They want to be involved. So look out for these things because these are the things that come to bite you later on. It's not unreasonable for them to want this. You just need to be clear on the parameters of how they want this, because sometimes they could stop you from making key decisions in your company, especially for emergency situations. What you want to do is to make sure that you're not signing anything that you can't actually follow through, even if it sounds reasonable. So make sure you go through it, reflect on it, think about situations where you need to do this and whether it's actually practical for your company. For example, a common request is that you won't violate any regulation or law in running your business, which is a very valid request from any investor or even anyone who's interested in your company. However, there are some regulations that you may not know that you're violating. For example, in Kenya, sometimes we find that there are all these laws, like bylaws, that you get to learn at very random points when you're running your company. Sometimes we're not even aware of some of the of the full nature of the laws or the bylaws that are required of anyone running a company. And so in such a situation, they would say that you have violated the covenant, which is a reason to dissolve the contract signing or the arrangement. So look out for these things so that you can just be very aware, and also that you can have conversations about the parameters around the violation of these regulations. It's important to also try and compromise and have that covenant change to agree instead that you won't knowingly violate any regulation or law, which is different from you won't violate, because this is you won't knowingly. So as long as you don't know it, it means that you haven't really gone against what the covenant says. Yeah. Next, please. Just takeaway, when negotiating, you won't get all these clauses completely in your favor, nor should you, because obviously the investors want to save their own interests. But understanding the implications of the clauses instead of just glossing over them and signing whatever is put in front of you can literally be the difference between a business sale that leaves you a multimillionaire and one that leaves you looking for another job. So what I'm saying is that all these clauses have such a huge impact on your company. Surround yourself with people who are able to translate these clauses, who are able to explain them to you so that you're very clear when you're getting into them.
You're a slave.
Yeah. Next, please. The other
Maji
thing
itamwagika.
we'll go through
Maji
is the debt
inamwagika.
contract. It's someone's mic that's on. Thank you. The other thing is the debt contracts and what to look out for when you're maybe getting a loan from a bank, or even a friend, a family friend, or someone who will make you sign a contract regarding a loan investment into your company. Yeah, thanks. Next, please. Yeah. So we have some things that there are key things that you need to look out for. The first thing is the interest. You need to be very, very clear on what the interest rate is. There are two types of interest. There's fixed fee interest rate, and then there's a floating fee interest. A fixed fee rate is set at a given number and it will not change throughout the loan, meaning that if the loan is for 5 years, year 1, year 2, year 3, it's going to be a fixed amount, 8%, 10%, it doesn't change. However, a floating fee rate is based on an intense interest rate margin added to a benchmark rate. I'll give the example of Kenya because we have a benchmark, which is the CBR, the central bank rate. And they say that the banks can't go plus 3% on top of the central bank rate. What happens is if you sign the contract now and the central bank rate is 10%, in another couple of months, the central bank comes and says, we have reviewed this and it's now at 10%. It means that your interest rate will be 1% higher in the next couple of months because the fixed or the base rate has shifted. So you need to be very clear when you're getting into this with the investor or with the bank or the microfinance institution. You need to be clear on what type of interest rate it is, and when to expect the changes and the shifts. Obviously, like even for them, they don't know because it's the central bank that releases this information, but then it's good to have an idea of how things work and how things have worked before. The second thing is a default interest. And usually a default interest is when you fail to pay your monthly installments, there's a default that's attached to that. So which is an interest that's attached to that. This clause increases the interest rate that is payable on amounts which are not paid when they fall due. It must accurately reflect to the lender the cost amount that has not been paid. So they need to clearly indicate what the default rate is. They could say 3%, 2%, but it should be written in the contract. Make sure it's there because if it's not, then they can come and say this month it's 10%, this month it's 5%. Like it shifts, it could shift. And so you need to just be able to, even for planning purposes, be able to know in case of a default, how much do I pay as a default interest. The third thing is a prepayment. Always demand for a repayment schedule if you get a loan from a bank or anyone for that matter. It's important that a loan agreement allows the borrower to pay the loan early. Some banks will not let you pay the loan early because they are losing on interest. So this is known as making a prepayment and making the loans more flexible. It's always good to be able to pay a loan early because it means that you're able to meet your obligations earlier than you had intended to. So if, for example, you realize that, oh, actually, I've made a huge amount of money from a sale and I have some extra money that can go towards the prepayment of the loan, some banks might not be able to allow that. So you need to be clear on whether this is something that's allowable. The other thing to look out for is events of default. They usually some contracts will state that these are the events of default, others will not. The thing is, for avoidance of doubt, it's important to have all these things clearly stated. And if they're not there, please ask these questions so that you can be very, very clear on what a default means to the lender. An event of default is simply an event which brings the borrower into default, meaning you're not able to repay back. The definition of an event of default will change depending on the one, it's the type of loan that you've entered into. The second thing is the position of yourself and the other party, and the major events of default that you should look out for. So the next slide is going to show us what these major events are. Is a cross default, where a default under any other on-demand facility provided by the lender to the borrower will automatically cause a default. So what this means is the bank, if you don't have a repayment schedule, the bank might come and it might be like repayment, they might say that it's the repayment on demand. Repayment on demand means that once they demand for a repayment, that's when you're supposed to pay it, meaning that you have no idea when this will happen. So in case of such a thing, and you're not able to meet this obligation, it's called a cross default, because then you're not able to pay that amount of money because you had not planned on repaying at that point. The second thing is a breach of the loan contract, where any breach of a term of the loan agreement will automatically cause a default. So you see all the clauses in the loan agreement. If you breach any of those clauses, whether it's on the interest payment, default interest, any of those clauses might lead to a breach of the loan agreement. And if you breach, then it means that you have defaulted. So you need to be very clear what they state. For some lenders, some breaches might not really mean that you're in default. So just be clear on what an event of default means to your specific lenders. The other thing is non-payment, where any non-payment of interest or capital automatically triggers a default. Some investors usually will give you a certain period of time, whether it's a grace period, and they'll give you some leeway and give you some time to be able to gather your capital, your working capital, and be able to pay back. However, others will not give you this provision. So it's important to know at which point is it deemed a non-payment. In the case of certain countries, there's where the Credit Reference Bureau, meaning that if you are considered a defaulter, then your details are automatically submitted to the Credit Reference Bureau. What this means is that you're not able to access any credit at all until your details are off the database. So you need to be clear on whether there are such repercussions in case of any non-payment. The other thing is insolvency, where the borrower going into insolvency is an event of default. So yeah, insolvency means that you are bankrupt and you're not able to, so you have to liquidate your property. Again, this could be deemed as an event of default, meaning that The loan also might prescribe that in case of liquidation, that the bank or the lender is paid first. So meaning that you have to consider the bank, and then you also have to consider your preferential shareholders. So these are the things that you need to keep in mind. The other thing is committed or uncommitted. If a loan is committed, the lender is contractually obliged to lend the loan amount to the borrower once they have satisfied certain conditions. The conditions could either be like, get your books together, these are the milestones that we need an audit. So there are certain contracts that are committed, meaning once you meet these conditions, then you automatically receive the investment. Others do not are uncommitted contracts, meaning that they could pull out at any point of the process if they realize that this is not a good investment for them, even while you've gone through such a long process. Like I said, it's also good to look at the repayment plan. Is it a facility to be repaid on demand, like I mentioned? Is there a set date on the schedule? So like some lenders will say you have to pay on the 5th of every month. So every 5th, while you're looking at your working capital, you have to know that this X amount is going to the lender. Generally, you and the other party to the loan agreement will agree to a fixed repayment schedule. However, on occasion, the lender may insist on an on-demand facility, which is particularly likely if the borrower has poor credit. Next, please. The other thing is secured or unsecured loans. So before you enter into any loan contract, make sure that you clarify with the lender whether it's a secured loan or an unsecured loan. The majority of loans are usually secured against an asset. However, in certain circumstances, the parties to a transaction may agree not just to secure the facilities. This means that there are repercussions. If the loan is unsecured, probably the interest rate is going to be much higher. And the loan may be on an on-demand rather than a fixed term basis. So yeah, there are repercussions to the loan being unsecured. Just make sure that you're very well aware of these repercussions and you know exactly what to expect. Next slide. Now we're going to go into grant contracts and the things to look out for before you sign a grant contract. Next. So one thing is that grant makers sometimes you'll realize that they use standardized contracts with predetermined clauses, which means that they won't always provide grant recipients with the opportunity to negotiate. So sometimes it's very, very difficult to negotiate a grant contract. Again, as I said, one of the things that we want to do is to make sure before we sign anything, we are aware of what we're getting into. The awarding of the grant may be dependent on the acceptance of those particular conditions and terms. So you might have an issue with a specific term, but then the fact that you're being awarded being awarded is based on your acceptance of these terms. So you don't have a choice in that sense. Even in standardized contracts, however, there can be room for negotiation around the attachments to the contract. When there is no opportunity to negotiate, you need to be very clear what your organization is being asked to agree to, and we'll go into that. Be mindful of any obligations you have to any other grant provider or sponsor, and make sure the position of these other parties isn't compromised. So look at what you already have existing. Do you have any other grants in your organization or in your company? What are the conditions of that, and do they collide in one way or another? Some grant, for example, some grant contracts will say these are the things that we are not willing to fund, and these are the things that we do not accept. They will list down maybe whether it's the sectors, whether it's the specific types of trade, like if you're trading in certain things like firewood, like the things, whether it's firewood, wood, like there are very specific things that most grantors will not engage in. However, you might meet some that do not have issues with these things. So if there is any type of a collision or they do not agree in some sense, you need to be very clear on what these areas are and how to navigate that. Especially because you could get a grant that could bring issues in terms of the conditions for this other grant that you're entering into, or any other grants that you have existing in your company. So make sure that you're very aware of what these conditions are with all the grants you have existing in your company. If the grant program manager expects particular outcomes, um, that you feel your organization won't be able to deliver, you need to put these issues on the table now. Maybe they want you to send weekly progress reports or weekly financial reports or like just a summary. And for you, maybe you have a lean team and people are on the field trying to deliver or something like that. So it's not practical for you to be able to, just be generating reports on a weekly basis. It's important to table that at the point where you're signing the grant so they can at least be able to shift the timelines. In my experience, once you mention this, it's not, it doesn't mean that they are not going to give you money. It doesn't jeopardize your grant contract in any way. They just want to know that at least whatever you're committing to, you're able to deliver. There's no point in hoping they'll be sorted out later because again, you will be way in over like trying to send reports and doing these activities. And then you will run late, you will be reporting late, and then that's where the issue comes in. So just flag it at the point where you're signing the contract. It's best to discuss the problem at the outset to try to come to a position that both the grant owner and the recipient can live with. Next, please. So there's a checklist here that I thought is really important for people to consider, and it's divided into responsibility and reports. It's the questions that you need to ask yourself and make sure that you have gone through and checked. Have I checked that the type of contract to be used is suitable for your organization? That there's nothing that's it's not colliding with any existing contracts or any existing contracts with any grantors or any investors in your company. That the project items we expect to be covered by the grant are included. That responsibility for publicity, the grant owner or recipient is agreed. Again, most grantors want some form of publicity for the activities that you're carrying out to say that, sponsored by this X donor. So you have to make sure that you're very aware of what this responsibility means to you. It could be that any type of external communication you make has to have the donor's logo. So be clear on these things, that we have achieved what we hope to through the negotiations, that we can live with the responsibilities the contract will impose on us. Again, make sure that everything is within your range and it's something that you can work around, that we know how to liaise with others involved. So some grantors will say they have partners they want you to work with, or they have people they want you to connect you to, and you have to work with in the activities or whatever. So make sure this is clearly demonstrated and outlined during the signing process, that we know who's expected to do what when the project starts. Again, it's all about the team and what the team is supposed to do. Who's the one who's directly communicating with the grantor or the donor? Who's the one who's updating them about the activities? Is there someone who's doing the reports? If so, who is it? When are the reports supposed to be done? Such things. And then make sure that you have checked when the progress and final reports are needed. Again, these dates are really, really important because if you miss them, then you are going to be in problems with your donors. What timelines are involved? By timelines, it's not only about reports, it's also about the activity when you're going to carry out your activities. We've seen situations where people or organizations have to take back money or move money back to the donor because they're not able to carry out the activities on time. And it's because of this timeline. Sometimes people will overstate, or like they will because you really want to carry out these activities. You'll say, yeah, we can do this in a month, or even when you're doing your work plan, you say, yeah, we can do this in 2 months. But realistically, when you look at the work that's involved in planning that particular activity, it takes so much longer. So you're not able to do your activities on time, and then some donors will require that you return back the money. That you know what's to be included in each of the reports. Every donor has their own reporting template. So make sure that they send this to you, sit with them, clarify what each of the areas in the reporting template means, or what you're supposed to submit. Some require that you even submit photos. So you need to know this when you're carrying out your activities, because you need to take pictures of every single activity you're doing. Some require that you have proof of whether it's like, if you're paying people, you have their IDs, all these things. If it's a financial report, be clear on what each particular donor requires. Ensure that you know the required format for reports, electronic or hard copy. Some just want the electronic or soft copies. Some require hard copies, and they also require that you submit like the whole project file to them. They could be in Germany or whichever country, but they still require a hard copy. So these are some things that you need to keep in mind also. That the purpose and the recipient of every report is clear. Again, yeah, just make sure that everything is clear and is clarified at the point when you're signing, so that you can know exactly what you need to submit. I'm really sorry for the noise, but there's another meeting going on in the next office. So yeah. Next slide, please. Finally, how do we effectively manage our investments? Next, please. So this is just a summary of, it talks about shareholders, but then I felt like this captures all the investors, because with debt, really what you need to do is just pay your monthly installments, and then they are happy. Most of the debt investors do not require a lot. However, in the case of specific funds like ourselves, Hiva Fund, we require regular updates. We require you to send regular monthly reports. That's financial reports. We require an open line of communication with any investor or any investment that we make, any entrepreneur, because we want to know exactly what is happening in your company. Ask advice from your investors, because they are experienced and they care about your business, especially for if they're
Hi, Vakiru. I think we have lost you. We have lost the sound. Ladies, please stay with us for a few minutes. I think Vakiru is just fixing the technical issues.
via email, calls, include your financials, and then, hello?
Hi, Vakiru. I think we lost you for a few minutes.
Oh, I'm so
In
sorry.
between. Oh
At
no.
which point? So do I go through
Yeah,
okay, let me just
if
start
you could
again.
just quickly.
Um,
Yes, thank you.
sure. Like I was saying, so what this captures for me is what all investors require, whether it's an equity or a shareholder, or whether it's a loan, or a lender, or whether it's a grant donor type of investor. One thing is to always ask for the investors' advice, because they're experienced and they probably have networks that they're able to connect you to and you can tap into. So it's good to always, like, talk to them and see what they think about specific strategies that you have for your company. Also share the bad news. I was giving the example of Kiva, where even though we invest primarily in debt, we are very invested in the outcome of the business. And so what happens is sometimes you realize that businesses are not performing like we had forecasted in the financial modeling process. And so in this situation, if you share the bad news, you say like you have not been able to meet your targets, what we do is we come back and we restructure the repayment, because again, we don't want you to be tapping into your personal savings to pay back a loan. So we'll go back and we will look at your company and we will restructure the repayments. Be organized. This is just about how you're sending your reports. Have specific, if they have specific templates, ensure that you follow those templates. Link your documents to your investors so they're able to see exactly the information that they need to see. I'm seeing people saying they can't hear. I don't know. Is the sound okay now?
Hi everyone. There was a technical issue. I couldn't hear anything either, but it is back on track.
Okay.
Vakir, if you could just perhaps increase your mic volume, maybe that could help. It's clear now. I can hear.
Okay. I don't know. It seems like I'm not able to use my mouse to operate anything. I don't know what hung at some point. Okay. So the other thing is to send regular updates. If a donor requires monthly reports, ensure you send the reports. Again, if you're having activities, invite them to the activities, involve them in what you're doing so they can also see what they have invested in. Include your financials so that they can see the performance of your company and they can be up to date with what is going on in their company. Next, please. Finally, how to keep your investors happy. I think I'll just talk from experience and from what we have experienced having invested in more than 40 companies over the last couple of years. The one thing that we are really happy about is people who communicate, and we find that women always communicate, so that's a good thing. Communicate and have open channels of communication with your investor. Be transparent. Transparency can come in several ways. Sorry, just a minute. So the other thing is to be transparent. By transparency, it's with regards to the performance of your company. Even if it's a grant, a donor still wants to know that you're doing your audits, that everything is okay, that there's no issue of misappropriation of funds. So these are the things that keep investors happy, and then they keep them investing in your company, whether it's a loan investment or shareholder or grant. Transparency is very, very important. In fact, one of the things that gives you a better advantage at getting any type of investment is the level of transparency, especially financial transparency in your company. Have processes that are already there, and then then all these things come naturally. Submit your reports. Like I said, send progress reports that track the impact of the investment into your company. Include activities carried out, any challenges faced. It's always really good to report this. Some people want to give like perfect reports, but that's not realistic. Talk about the challenges. If you have any delays, inform the investor in advance. track the budget versus the actual amount spent, and highlight everything that you feel the investors need to know. Again, stick to the plan. This is the best case scenario. However, we all know that sometimes plans do not work out. So if it doesn't work out, inform the investor in advance. Whether it's the donor, inform them that, okay, we were looking to have, this done by this time, but now we can't because there are delays on the other end. Just tell them why. If it's a loan, stick to the repayment plan as much as you can. If it's a grant, ensure that you carry out activities as per the approved plan, and then include them in any planned activities so they can experience your activities, your company, what your output is, whether it's a project, anything that you're doing, and they can experience it for themselves and actually see what the money is going into. Yeah, and that's the end of my presentation. I'm really sorry about the sound issues, but I'm in a really loud place, so I was just trying to work within the the environment that I'm in. But I hope at least you've been able to, or I've been able to capture the key things that are really important with signing contracts and management of investments. So if you have any questions, please let me know, and I'll respond to them right now.
Thank you, Wakiru. If you have any questions, please use the chat box on the bottom right corner of your screen. I can see some people, I can see a lot of thank you messages, someone asking for your phone number. I think we cannot disclose that information. Our apologies. Thank you. Yes, I have one question from Ashwini Satnur. When the parameters of profit margin are equal for all the type of financials such as equity and grants, what is the selection choice algorithm that could be made? That is quite a technical question there.
Yeah, I'm trying to understand it. Is it possible for the person to ask?
Ashwini, if you could unmute your mic perhaps and repeat the question. There are also a few other questions that we are receiving.
Yeah, I've seen someone asking.
Yes,
Okay.
hi, Ashwini.
I'm Ashwini here. The question basically is there are multiple choices such as equity, loans, and grants which could be selected by any end user for any product as such. If all the profit margins for all the channels for financials is equal, in the sense if it is 50-50% for loans and equity and grants, then is there any design algorithm or a selection criteria which could be mandated and suggested to select any one of these options for carrying on that particular product or something?
Okay, so you're talking about if let me try and understand.
If basically the returns that could be obtained from any of these options is the same, then which one would you choose, as whether you would go for equity or whether you would go for loans or whether you
Okay.
would go for grants?
So there are several things to look at. One of the things is it only money you want from this investor, or is there something else you need from them? Yeah, because for a loan, the investor will only be there to give you that amount of money. All they want is for you to pay back. Some investors are different. Like I said, like for Hiva, we are very interested and invested in the growth of the business. And so we try to make sure that we are very present and that we give feedback and also we give financial advice. So if it's only the money that you want, you could easily go to a bank um, and get the money from there. However, if you want more from the investment, if you want someone with experience to come into your company and help you with the day-to-day or the management or the strategy of your company, then it means that what you need is an investor who is more, who's able to put in more. And that, for example, is an angel investor. It could be just an equity investment, because then that comes in with, they are now shareholders like yourself. So they are very invested into the success of the company. With an angel investor, you want someone who has been in the same industry for a while. They have networks, they're able to open doors for you, and they're able to link you to other people in the ecosystem to grow your business. Those are some of the things that you need to think about. Have I answered your question?
Yes, definitely. Thank you for the clarification.
Okay.
Thank you. Okay, I have a question from Comfort. She's asking which of these loans would you recommend for SMEs?
Okay. So there are, in terms of loans, there are different types of loans. Like you said, they are secured, unsecured. Um, there are fixed interest loans. There are, floating interest loans. So again, I'll say, go back to your company, look at the actual needs. If you don't have any security, then it means that you have no collateral to offer. So obviously you need to go for an unsecured loan, yeah? However, the unsecured loan comes with other repercussions. It could be that the interest rate is a bit higher depending on where you are. It could be that you have to pay, or the repayment period is much shorter. So again, there's also like short-term working capital loans, like LPO financing. What do you need the money for? Do you need the money for a long-term project, something like more than a year? Do you need the money to just be able to produce to be able to meet a certain order? So you have to ask yourself these questions, and then once you have the answers, then go back and look at what is available in the market. Banks offer LPO financing for working capital. Could be like for 3 months. So if you need to be able to service an order, you can take a short-term loan. Again, think about all these things before you decide on which particular type of loan you're going to go for.
Wonderful. Thank you. Another question from Mel. What kind of instruments does your company provide?
So Hiba invests in several ways. We do invest debt investment, primarily debt investment, but then we also have something called convertible debt and equity. So I'll go into the debt. So debt, what we do is there are different types or different models. We have the usual term loan on a fixed interest rate. And that's on a reducing balance, meaning that, yeah, it's on a reducing balance basis. For the term loan, it means that you're paying a certain amount of money every month for the next couple of years or for the period of the loan. We also have a revenue share model for the loan. The revenue share means that we do not expect you to pay a fixed amount every month. What we expect is a percentage of your revenue on a monthly basis, not profit, but revenue. So any money you make on a monthly basis, if this month you make maybe $100, we will decide on a percentage, maybe 8%. If the next month you make $50, we will again take 8% of that. If the next month you make $1,000, we will expect 8% of that. So that's the type of structure that the revenue share takes. We also have the convertible debt, and for convertible debt is where we invest we loan you a certain amount of money, and then we say we are going to have this money in your company for the next 2 years. We do not expect any repayment for 2 years. Then after 2 years, then we have the conversation whether to proceed as debt or to convert to equity. And so that usually has its own framework. And the advantage of it is that you can get money for a medium to long term period to be able to carry out certain big investments in your company. But then that after a certain point, we have to have the conversation about whether it's debt or equity. Yeah.
Perfect. Thank you. I have a few more questions if we can take them. Is that okay with you? Hello?
Hi. Yeah, it's
Yes.
okay.
Okay. Thank you. Yes. Sorry, Yes, a question from Anna. How do you prove to the investors that you've not broken the laws knowingly?
So, that's a very good question. I think some of these things, honestly, it's just like being able to have honest conversations with your investors. Like I said, especially in Kenya, there's some laws that just appear randomly. You've been running a business for a while, and then something happens and you're told, oh, so there's a law that you can't do A, B, C, D, and you genuinely did not know. I think it's just about being honest, and especially if you have a relationship with this investor, I would say that already the investors are aware of, like, I'll give you from our perspective, we already know, we kind of know the people who we have invested in, and we know that they're not capable of doing certain things to their knowledge, yeah? So because we've built a relationship for so long, for a couple of years or for a couple of months, we're already aware of the frameworks that they operate in. In a country where some things are very unclear, I think the clause on having knowingly breaking a certain law is very important, because things are not just as transparent, like the policies or the laws or the bylaws are not so transparent. So any investor knows that if you come to Kenya, there's certain things that you should expect, and there's some things that are not very, very clear for people who are operating businesses. And so I would say that it's just having that relationship with your investor that helps, because then you're able to flag something as soon as it happens, yeah? So you're able to tell them, we just, we just became aware of this. These are the implications, and this is what we are doing to be able to rectify what has happened.
Thank you. Another question from Mel. If we are doing a presentation for investment, what are the key ratios you look into that we need to present?
Okay. In terms of ratios, so we look at different things. We look at the income statement, and then we look at the balance sheet. For the income statement, we look at the gross profit margin, we look at the net profit margin, and all the other liquidity ratios. This is, maybe we can have like a more one-on-one direct conversation about this, but the way we do it is we always we're not expecting that the company is profitable all the time, but then we look at the historical ratios and whether there's any growth over a certain period of years. Again, with the balance sheet, we look at specific ratios, and we want to know, all we want to see is that there's some level of growth within a specific time frame, so we can decide whether it's worthwhile for us to invest in that company or not, or even whether a company is able to take up um, debt as an investment. Because you find that sometimes people will apply for a loan, but then they're really not able to pay back. If you look at their profit margins, like they don't have, their ratios are not making any sense. So what we do in such situations is we just have an honest conversation and say, we feel that you're not ready to take up debt, but we are willing to support the company in any other way, whether it's access to market, business support, or whatever gaps that they might be having internally.
Perfect. Thank you. We just have I would take three very quick questions. Number one from Patricia. She's asking if you offer grants.
Um, so we only offer, we have something which is called a mixed model, which we only do for one of our funds, which is a seed fund. And by mixed model, we mean that it's a mix of grant and a loan. So you don't get 100% grant. For working capital issues, we give the loan, and then if you're looking to maybe experiment on a specific product or test the market, that's what we will give you a grant for. But like I say, this is only for the seed capital and not for any other of our funds.
Thank you. The second question is from Temi. Uh, she's asking if we can divide or combine investment into equity and stock share.
What does she mean by equity and stock share?
Temi, if you're still here, could you perhaps explain the question? Can we take another one in the meantime?
Because what happens when someone or an investor comes and takes equity, it means that they have bought shares in your company. So if their equity is 30%, it means that, yeah, they have bought shares worth 30% of your company.
Okay. Thank you. The last one is from Grace Ann, who's asking if the organization is a partnership, will it be treated like a registered company?
So is it an LLP?
Grace, if you're still online, could you perhaps
Because, yeah, because an LLP, uh-huh.
Yes.
Okay, because a partnership is also a registered company. It only means that the partners are more exposed. A limited company protects the individuals in case of any bankruptcy or in case of any issues. The company is seen as its own separate entity. Even if the company incurs any profits or losses, those are profits and losses on the company, not on the individuals. However, with a partnership, it means that the partners are exposed. So if the partnership makes any profit, there is obviously like a distribution of profit. Maybe it's a 50-50 distribution if it's two partners. What that means is that 50%, if what the partnership agreement says is that the profit is shared equally amongst the two partners at every end of the year, then the partners have to pay taxes, ideally, on that profit that they have received or any money that goes towards them. So yeah, what happens is that with a partnership, the individuals are more exposed. However, with a limited company, there is the security of having the company as its own separate entity.
Wonderful. Thank you so much, Vakuru. I think this is it. I think we addressed most, if not all, questions. Thank you to everyone who participated in the webinar today. We will be having a lot more webinars as part of the SheTrades Invest series. For any information, please stay tuned on shetrades.com. Any closing statements from you, Vakuru? Hello?
Hello?
Yes. Anything you'd like to say?
Oh no, thank you so much for listening to me and for asking all the questions you've asked. I'm happy to answer any other questions you might have. And yeah, just have a lovely evening or day, depending on where you are.
Thank you. Thank you, everyone. Have a great evening. Bye.
Bye.